Point is, there's no such thing as a free lunch, okay? But let me explain. Fractional reserve banking, for those that do not understand what the caller is talking about, is the ability for a bank to take in $100 worth of deposits, take $10 and put that aside, and loan out $90. The $90 gets spent, it comes back into the bank. I can now loan out $81. I have to reserve $9, and in a sense, the bank fans the money into several times what was originally deposited. If one depositor comes in and asks to see his $100, he can, but if all of them come in and ask to see their $100 at once, the bank doesn't have it. Okay, that's the gimmick. Now, here is the thing that goes with that, though. Banks have an operating cost. They have a building, they have a vault, they have tellers, they have officers, they have computer systems, all things that go into this to actually operate a bank. In order for you to borrow capital from somebody, you have to pay them something for the time value of that money, and that's interest. If you get rid of fractional reserve banking and you have $1 come in deposits, I can loan out at most $1, and that's it. I cannot fractionally reserve. Then the problem that I run into is that in order to operate the bank, I need to charge you the full margin on that loan instead of the inverse of the reserve rate. So if I have let's say, just for the sake of argument, we have a 10% reserve ratio in a banking system, you are going to pay about 1/10 of what you would otherwise pay, and it's actually a little more than that because, of course, everybody needs to make a profit, right? We don't do anything
for interest on a loan.
Well, we don't do anything for free, right? Nobody does anything for free.
Yeah.
So you pay much less in interest as a percentage than you would pay without fractional reserve. That's the benefit to the consumer. Now, here's the cost. Here's the cost.
Okay.
Nobody will loan money at a rate that is less than the risk-free rate of return that is the growth rate in the economy. All right? Nobody.
Well, they're getting it pretty cheap from the Fed, though.
Well, but it doesn't matter. The point is you would be crazy to loan out money for less in interest than you can earn with no risk, right?
Yeah, that's true.
You'd be nuts to do that. Okay. So I'm always going to charge you more than the economy grows at. The problem with this is that because of the way the law of exponents work in mathematics, as time goes on, the interest that has to be paid becomes larger faster than the growth in the economy does. And this spread increases over time. It gets much worse the longer you go. Over 3 or 4 or 5 years, it's not so bad. Over 30 or 40 years, it's horrible. And over 100 years, it can't be paid. Okay? So what fractional reserve does is it gives you this benefit, but the price is that at certain intervals, which are determined by the economy, you have to have recessions where these bad debts get flushed out of the system because you have to knock the debt levels down. If you don't, you get what we're doing now. Okay? So when the government gets in the middle of these things, and see, we had a recession in 2000, 2001, 2002, 2003. It was going to be a pretty bad one. Instead of allowing that to happen and flushing out all the bad debt in the system, the government stepped in and stopped it. Well, now we're paying for that stupidity. This is the problem with tampering with that cycle. So whether or not fractional reserve is good or bad entirely depends on whether or not you're willing to trade off the much higher cost of borrowing money in exchange for the fact that you must have a business cycle and that excessive debt on some set of cyclical basis has to be flushed out of the system in any fractional reserve system. Always. Has to be that way. This is the flaw that Bernanke has in his thought process. Classical monetary theory says if you grow the money supply, it will cause velocity to increase because circulation will increase. That's not how it works. The truth has now been shown by events of the last couple of years that what actually happens is the credit growth drives the monetary growth. It's not the other way around, even though you have a lot of classical economists that would try to tell you it is. We now have the evidence is in, the test has been run. We were the experimental petri dish, and we now have the results. So the problem is that we're trying to stop the destruction of tens of trillions of dollars worth of credit by putting in, $1 trillion worth of money. You can't. The numbers are too big. What broke is that people went too far with leverage. they grew asset values beyond the sustainable amount. This is what happens when you allow leverage limits to be removed, and when you allow people to gear up without any expectation of any sort of reserves. When we got rid of 20% down payments on mortgages, we went from 5-to-1 leverage for the consumer who bought a house to infinite leverage for the person who put nothing down and got 100% financing. That's where the problem is. When we took the limits off the investment banks, it was 14-to-1 was the leverage limit. Paulson went in. Henry Paulson, former Treasury Secretary, went in 2004, asked Congress and the SEC to take those limits off. They did. All of the firms that have blown up, every last one, Bear Stearns, Lehman Brothers, Fannie Mae, Freddie Mac, AIG, all had double or more the formerly lawful limit of leverage at the time they went down, anywhere from 30-to-1 to 80-to-1. Every last one of them exploded because of excessive leverage, no other reason.